Thank you, everyone, for joining a webinar hosted by Bernie Wealth Management. Today, we're going to talk about the pros and cons of diversification. Specifically, what does it mean to diversify your portfolio and how you should go about the process of selecting what asset classes should be included in your investment allocation and in what percentages. We'll also take a look at the historical characteristics of some of these asset classes as well as their pros and cons. There's a lot of misconceptions out there about diversification. There's many rules of thumbs. So we're going to try and incorporate some of those into this conversation and just help you better understand the art and the science behind the diversification process. We'll start things out by specifically defining what diversification is. And at the highest level, diversification is a risk management technique that mixes a variety of investments into your portfolio together. So rather than have a portfolio that consists of only cash, only stocks, or only bonds, diversification incorporates some percentage of each of those categories and maybe some others as well into a mix that is suitable and appropriate for your goals and your appetite for risk. So what you accomplish or hope to accomplish by diversifying is that the collective efforts of all of the different pieces of your portfolio will provide a more predictable investment experience and have a much lower risk level than any one individual asset class in the portfolio. So that is really just a general definition of what diversification is, and we'll expand on that as we move ahead. And so one of the questions you have to ask and we have to understand together is why we do diversify and why you should diversify comes down to three main benefits. The first being more reliable outcomes for your portfolio. So individual asset classes go through cycles. So the stock market, the bond market, they go through periods of time of different ups and downs, and the volatility associated with, especially an all-stock portfolio, can be unpredictable in the short term. You can have very good periods and very bad periods. But when you diversify and you incorporate other asset classes into a portfolio, you minimize the upside, but you also minimize the downside, and you tighten the range of your returns, which provides for more reliable outcomes. So if you're looking to invest for a goal, you get more predictability with a diversified portfolio than with just a portfolio of one asset class. By diversifying, you also lower the risk of your overall portfolio, and we'll look at that in a bit and quantify some of the worst case scenarios. We'll go back historically into some really tough periods for the market, and we'll look at what would an all-stock portfolio have performed versus a diversified portfolio. And when you diversify, you spread your bets across the board. So you capture returns wherever they recur. So you're not trying to predict 1 year what the top performing asset class is going to be, because you'll already have some level of exposure there. So diversification, it doesn't allow you to always be the best or always be the worst, but allows you to capture returns when they occur, which again, going back to point number one, helps provide a very or somewhat predictable investment experience. In a tandem with this, and kind of a fourth benefit that I think is really important, is the behavioral side of things. So as investors, we are not particularly wired well from a behavior aspect when it comes to the investment process. And I have here some mental errors that we see investors run into, or roadblocks, should we say, to staying invested for the long term, which is really the most important aspect of the investment process, being able to let your money grow and ride the ups and the downs. So some of these errors are related to overconfidence. So our ability to think that we're a lot better at investing than we really are. Some of these are related to our short-term memory when it comes to investing. So thinking that current trends will just continue to repeat themselves forever. So if the market's going up, it must mean that it's going to be going up forever. Or if the market's going down, it must mean it's going to tank or go down forever. We know this isn't the case, but mentally we have a hard time overcoming these roadblocks along the way. So when you diversify, you somewhat take the behavioral aspect somewhat away from the investment process. So you're not trying to pick and guess and choose what the next best trend is going to be. You're not trying to jump ahead of the market and determine what's going to happen next, because you have exposure across the board to different types of investments. So we know a little bit about what diversification is and why we should consider it. Uh, but when should you not diversify across asset classes? So just like anything, there's pros and cons. And let's say the cons of diversifying is that for someone who has a very long-term time horizon, and we define that as 20 plus years for their portfolio, uh, if you have that long-term time horizon, you can ride out from a number standpoint, you've got enough time where you can ride out the volatile times in the market. So if we have a really bad 3-year stretch, if you're invested for 20, 30 years, um, those short-term movements aren't going to have as much as an impact on your long-term results. So for someone with a long-term horizon, as we'll see in a minute, stocks have the highest upside and highest long-term returns, but they have the most short-term volatility. So if you have a long-term time horizon and you don't have an all-stock portfolio of bonds and cash, those lower risk, lower return asset classes are going to drag down your expected long-term return. The other side of this goes into our willingness to take risk, which we'll also talk about in a minute. This is our appetite for the ups and downs in the market. So a big reason of why we diversify is uh, to help manage ourselves and our behavior. So if the market goes down 5, 10, 20%, different people feel differently about that happening. So there are some investors out there that a 20% drop doesn't faze them, and they can afford to take more risk and afford to ride out those periods of time, and will subsequently most likely have a longer term, higher return. But if you can't afford those, market swings and the volatility, you probably can't afford to take the amount of risk that someone who would, be fine with it can. So risk tolerance, if you have a high risk tolerance, um, you're probably in an okay position to have a more concentrated portfolio, all other factors being equal. And this is here ties into that last point. This is a chart showing on the vertical axis is the value of a portfolio, and on the horizontal axis is time. And this is from 1800 all the way up through 2010. So a significant time horizon, and you could see the return. If you invested $1 in stocks, bonds, gold, or cash, from the start of this period of time all the way through 2010, what your real return would be. And this is, when you say real return, it means the return after the impact of inflation. And it's really evident here. Stocks are the only asset class where you can take a ruler through it, and it's pretty linear from left to right, pointed up into the rightwards direction. So there's more swings in the shorter term windows, but stocks are clearly the highest upside long term asset class, which is why they're the real key growth component of your portfolio, but they will have the most and the deepest short-term volatility swings. So how should you diversify? What's the science behind approaching the diversification process? And we think this boils down into two main inputs that should drive what percentage should you have in cash, stocks, or bonds. So your asset allocation should be a function of, number one, your ability to take risk. And your ability to take risk is really driven by your personal financial plan. It's purely quantifiable in nature. It's looking at what are your assets, what are your liabilities, what do you want to accomplish in the future, and what's the specific rate of return that you need to generate on your portfolio to help you get from point A to point B. So your ability to take risk, the output of that is some number. What's the required return for your portfolio? And this is unique to everyone. Some people have a required return of 4%, others have a required return of 9 or 10%. So that return that you need to generate translates into some portfolio. So is it all stocks? Is it all bonds? Is it something in between? That ability to take risk, the output of that conversation is, here's the right portfolio for you based on what you want to accomplish. Now, that needs to be factored in tandem with your willingness to take risk. Your willingness to take risk is your personal appetite for the ups and downs in the market. So, how do you react when we hit very, very turbulent times like we did from 2007 to 2009? People, just like their ability to take risk, their willingness to take risk is unique to them based on their experience, based on where they are in life. Some people are fine with big movements in the market. Other people don't want to be participating in up and down swings. So one of the ways to approach this is to ask yourself a couple of questions. So how would you react if your portfolio dropped by 20% of its value? Would you buy more stocks to take advantage of uh, the, the downward movement in the market? Would you take no action at all? Or would you sell stocks to stop the bleeding? Another thing is, how would you or your portfolio losing 20% of its value impact your ability to reach your financial goals? So would it have a little impact, a moderate impact, or a big impact? Now, that's something that your financial plan will dictate. So people have different ways that they would react from an emotional standpoint, and people's assets based on what they have and what they want to do in the future, there's a tolerance level there as well. So you need to look at both of these and determine what's the appropriate mix of investments that should drive my future and my portfolio. So it shouldn't be based on what the hot sector or the hot asset class of the day is. It should be very scientific in the sense that it's unique to you and your personal situation. So once we have an idea of our ability to take risk and our willingness to take risk, we need to determine how do we want to distribute our assets and our portfolio. And to simplify the conversation, uh, we're gonna say that there are four main pillars to your portfolio that should be included from a diversification standpoint. There's cash, bonds, stocks, and alternatives. And alternatives is just a catch-all phrase, as we'll see in a minute, that just is really anything that's not a stock or a bond investment. So alternatives can somewhat be seen as the Wild West, and that there's many different types of investments with different risk factors and liquidity factors. But for purposes of this conversation, it's one of the four pillars. And we're going to quickly go through and talk about just a brief definition of what each of these asset classes are. What are the historical characteristics? And then we'll start to combine some of these together to see how a diversified portfolio reacts versus any one of these asset classes in isolation. So the first one we'll talk about is cash, and why as an investor would we have cash as part of our portfolio? And this is a pretty easy one. On the left-hand side, I've got just a listing of cash accounts or types of cash vehicles. Some will be familiar, some will not, but this is a general summary of the cash asset class and what's out there that you can invest in. So why we place money in cash or why cash is part of our portfolio, the big thing is liquidity. Cash is easy to get our hands on. It's accessible. It's readily available. It doesn't need to be bought or sold for you to transact with cash. And the other thing is the safety aspect. So FDIC insurance, which is issued by the U.S. government, protects the full principal value of your cash accounts up to certain dollar limits. So unlike a stock or bond investment that can bounce up and down daily, with cash, your principal is stable and it's safe. It's not going to lose value. But as you'll notice, as I have here in parentheses, perceived safety. Now, the reason behind that is the impact of inflation over time. So just to use an example today, we know the rate of inflation is running somewhere at around 3%, but you're only earning at most 1% on your cash account. So the cost of living is going up by about 3% a year, but your cash investment is only growing by at most 1%. That's the concept of going broke safely. Cash, because it almost has no risk, it has almost no return. So cash should be there as the stable, the liquid component of your portfolio and your household wealth, but it shouldn't be such a large allocation that inflation is eating away at your net worth over time. The next is bonds, and just like cash on the left-hand side, I have an example of some different types of bonds, and I'd say many of our clients and many investors are very, very familiar with cash, and they're familiar with stocks, and bonds become a little bit of an unknown. So I'm going to quickly define what bonds are. when you invest in bonds, you become a lender, and you make a loan to either the government or a corporation. So when you buy a bond, you're lending your money for a set term, for a set principal amount, in exchange for a coupon payment that's an interest payment made to you by the lending entity. So bonds are right in the middle between stocks and cash on the risk ladder. And the reason why you invest in bonds is two reasons. You've got the income component from the interest payment that you're receiving, and you also have stability. And again, we'll define this more specifically in a minute. But what the bond market does, and it's very interesting, is it acts as a very nice balance from for stock market volatility. So in periods when the stock market is really swinging up and down, the bond market is oftentimes relatively stable. So it adds a balancing aspect to your portfolio. And you'll see bonds have lower return, but they have the income component, and they add that stability during periods of market turbulence. So just as an example, in an extreme case, when between '07 and '09, the S&P 500 dropped by about 50%, the bond market was relatively stable. If you were in a portfolio of high quality bonds, you would have returned somewhere in the low single digits most likely during that period. So in a really doomsday or bad scenario for the stock market, bonds provide that really attractive balance. The risk with bonds is with interest rate risk. So bonds, as interest rates go up, the value of bonds goes down. And as interest rates go down, the value of your bond goes up. But if you're in a rising interest rate environment, like many are talking about more recently, if you're in a rising rate environment, you need to be careful because if you hold longer term bonds and rates go up, what you're holding is then less attractive, and it might lose some short term value that you just have to be careful with. And just to put this into perspective, I'm going to quantify this. I've got some data for the bond market going back to 1985. We've got the average return over that 30-plus year period. So the bond market since 1985 has returned just under 7%. The highest 3-year return, annualized return for the bond market was between 1985 and 1988, was just under 15%. So for a 3-year period, you would have earned almost 15% per year. That's let's say the best case scenario of the last 30-plus years. And then lastly, the lowest 3-year average return for the bond market was just about flat, just about 1% between 2015 and 2018 when we were stuck in a really low interest rate environment. So you can see bonds, this gives you an idea of what the average return has been, what the highest and the lowest scenario has been for a 3-year period. And what we'll do is we'll compare that to the stock market. But first, let's quickly define why we invest in stocks. I think this is an easy one for everyone. Stocks are really going to be the growth component of your portfolio. If you go over any meaningful time horizon, 20-plus years, stocks are far and away the highest upside asset class because of their growth. You get to participate in the growth of the companies that you're investing in. So it gives you the full access to the growth of the firms, but that also goes in both directions. So that causes the volatility. You get all of the upside and all of the downside with your investment. With the stock market, though, there's risks that are a little unique. There's company-specific risk, which we call business risk, and then there's market risk, which is just related to the environment that we're in at any point in time. So business risk is the risk of any individual company that you invest in the stock market. So an example is Chipotle, for a very long stretch of time was an attractive stock that was really, really favored by the investment community with high returns, high growth prospects. But people started getting sick from eating their food. Several Chipotle locations were reporting illnesses, and that made investors concerns about the viability of the food quality for the business and trust, consumer trust. But people keep going back to Chipotle to eat, even though others were getting sick by doing so, and that caused the stock price to fall pretty significantly. So that's a business-related risk. It's very specific to Chipotle. Then another extreme case would be Enron. We all know what happened back in the 90s. Enron went completely out of business. So if you were an investor in Enron, you would have lost all your money. Then there's market-related risk, which is, again, not specific to an individual company or their characteristics, but just the market as a whole. So as an example, there were concerns earlier this year about conflict with North Korea that caused market volatility. So the stock market went down and companies went down in terms of stock price. And it wasn't related to their operating performance. It was specifically related to geopolitical concerns. We saw this also a couple of years ago with Brexit over in Europe. So people were concerned about the future of the European Union. That caused a lot of stock market volatility, not related to any one company in particular, but the market went down. So when people say the market's going up or the market's going down, that's really market-related risk and not so much business risk. So for these risks, though, there has to be some level of return. And so just like we did with the bond market, let's look at the average and some of the 3-year return periods for the stock market. So same window of time, we're looking at, almost 30 plus years of history. The average return for the stock market was just over 11%. So compare that to 6% for the bond market. That gap represents the risk you take on when you invest in stocks. The highest 3-year return for the bond market was just over 13%. In this case, it was just over 14%, and for the stock market, it's over 30%. So there's a 3-year period between 1995 and 1998 with a stock market return per year on average over 30%. So significant upside. On the flip side, compared to the bond market that had a 1-year, worst 3-year stretch over that 30-year period of about 1% per year for a 3-year period, compare that to almost 16% average downside for a 3-year period for the stock market. So this helps very clearly, create the appearance of stocks have that higher return. So if you have a long-term time horizon, you can capture that 11% or whatever that number is, but you have to be okay with short-term rough patches, in particular, potentially 3-year periods where you're down almost 16% per year. So think about that from the behavioral aspect as well. If your portfolio is going down that much over a 3-year period or a 5-year period, are you going to be disciplined and stay in the stock market? For some people, the answer is yes. For other people, the answer is probably not. I'm probably going to be inclined to sell stocks low and position into something else and try and get back in later. That's the kind of behavior you want to avoid, and that's why you diversify. And so when we think about the stock market, us as investors, we tend to have what they call a home team bias. So either all or an overwhelming percentage of our portfolio is 100% in the U.S. market. And this map here is meant to represent the opportunities by investing globally. So if you're looking to diversify your portfolio, even if it's all stocks, this helps you to understand that in terms of global market capitalization, the U.S. is only about half of the global stock market. So if you've got 100% of your portfolio and only half of the stock market, global exposure, there could be some opportunities outside of the U.S. that you might want to consider. So there's international developed and emerging markets, which over time with globalization, I know the world's becoming more connected to one another. And in the U.S., we've got large multinational firms. But as I'll show you in a minute, there are opportunities, especially with mid and small cap companies outside of the U.S. that can help provide a nice balance and additional return upside for your portfolio. From a statistical standpoint, and we're going to go back to the same 30-year time horizon, just like we did with U.S. stocks, bonds. I'm going to show you the difference between the U.S. and the international market over the same period of time. So I've got here listed, and this theme of characteristics will repeat itself over the next few slides, but I've got the average return, the highest 1-year return, lowest 1-year return, and then those 3-year best and worst case scenarios for the stock market in the U.S. versus the international stock market over this period of time. So you can see, what the averages have been, what the best case and the worst case scenario looks like. But I've got this other component here at the bottom called the standard deviation, and this is a statistical it's a statistical factor that helps you understand the ups and the downswings of a particular asset class. So without getting into the calculation or the details of it, all you need to know is that if the standard deviation number is higher comparatively, then that asset class is riskier than the one you're looking at it, comparing it to in the short term. So you see with the US stock market, the standard deviation over this time period is just over 15. For internationals, it's 17. So international, you've got a little more risk, but the return characteristics aren't drastically different. And as you'll see soon, the balancing aspect, presents a good component of the portfolio that you might want to consider. And so let me quantify that. So what we're looking at here is the same characteristics on the left, U.S. stocks, international stocks. This is literally the same numbers I translated from one slide to the other. But what I did in the final column here is I said, what if we took a portfolio and allocated 80% to the U.S. and 20% to international? It's just an 80-20 split between those two columns. And what you can see here, and this is really where I want to hammer home the concept of diversification. You've got a return that's not significantly different than that of just the U.S. market in and of itself. But go down to that standard deviation number. What we've done is we've really not changed the return significantly, but we've lowered the risk. And that's really, within, and we haven't even looked at bonds or anything else. We're just diversifying within the stock bucket, and we've already made some progress. You can see not much of a change to the return, and the risk level has gone down. And this is a graph that shows, in picture form, really the same thing. This is from 1970 to 2017 along the top here. You can see, what I'm just trying to show you is in what years did the U.S. outperform international markets and vice versa. And so for each year, if the S&P, the SP is the S&P 500. If it's green, it means it outperformed the international markets, and if it's red, it underperformed. Okay, so it's ranked from highest return to lowest return. And then the G, that brown G, is just a global stock portfolio. So it's really just about that 80-20 split between the two. And what you could see is that going back to the idea of more reliable outcomes from that second slide, that G somewhere hovers around the middle across the board. It's never really, and not very frequently the best or the worst, but it's always somewhere in the center. It's a more stable. So let's build on this conversation and just add a column that will show you the bond market over the same period of time. And so what I've done here is, taken that prior slide with the 80-20 U.S. international stock split, and I want to compare the characteristics of bonds to everything else that we've looked at so far. So the main thing here, you can, look down from top to bottom at the return characteristics of bond, especially the lowest one-year return. That worst case scenario is significantly better than for the stock market. You don't get nearly as much return, but again, going back to the risk conversation, the downside is a lot lower in the short term. But the standard deviation number is, a fraction of the market. So like I said, the lower the standard deviation than relative to other asset classes, that means it's less volatile. So the standard deviation of bonds is, a fraction of what the stock market is in the short term. And I keep saying the short term because over 20, 30-year periods of time, the risk of stocks and bonds, you compare it, they almost neutralize each other, because the stock market, over 20, 30-year periods, you get more time to recover from bad periods in the market, and you get more upside. So the risk of bonds long term is, it becomes neutralized to the stock market because you get less return, even though you get less volatility. Stocks are less risky the longer you can hold on to them. So we're really focusing on shorter windows of time, which translates into your goals, and why it's important to consider both factors. This chart here, this is there's different colors happening, but I'm looking over a stretch of time, and you can see different asset classes from 2003 to 2017. And what I'm trying to really explain is that you never know what markets are going to outperform from year to year. So we've got, many different asset classes here, and some are doing well for a period and then drop to the bottom of the list and vice versa. But this is, as we move into the next page of this conversation, just meant to show you the timing aspect of this and how, you know, we don't ever know what the asset classes will be best or the worst. Uh, and this is the timing that goes behind it. So, what does it look like when you've got a globally diversified stock portfolio, but now you want to consider including bonds as part of that? And so, what I've done here, going back, we're really repeating ourselves in terms of the data that we're looking at. But what I've added here is a different allocation of bonds for that person's portfolio. So at the end here, we've got a 70% global stock and 30% bond portfolio, or a 30% stock and a 70% bond portfolio. So kind of two extremes of the risk spectrum. And I want you to just be able to compare this to all US stocks, all international stocks, an 80-20, that global stock portfolio with no bonds, and then start to add bonds in and see what happens. So you can see the best case, the worst case scenario, that standard deviation number, again, it goes down. And the higher the allocation of bonds, like that last column, the lower the standard deviation. So this isn't meant to tell you any one of these is better or worse than the other, but it's helping you understand the trade-offs, and it's helping you maybe identify which of these would be appropriate for your goals. And diversification, across asset classes is important. So we looked at stocks and bonds, but you really also want to diversify, within the various layers of each of those asset classes. So just as an example, you can see here, same data points, but the four quadrants of the U.S. stock market. So large cap growth, large cap value, small cap growth, small cap value. Each of these quadrants, or style boxes as we call them, have their own unique characteristics. So it's important to diversify amongst these four buckets. We do this through our size and style responsive strategy, where we identify through market cycles, where should we be tilting our portfolios: large, small, value, and growth. So it's very important not to ever have all of your exposure in just any one of these buckets. There are times when growth stocks, large cap growth stocks especially, more recently have been very much so in favor, but these things move in cycles. So we'll go from growth to value and from large to small. This is incredibly important to consider also when you're investing internationally. So many of the major international indexes are incredibly large cap heavy, and we think that that's something that misleads investors to the actual potential of the international stock market. And I'm going to really hit home here with that by showing you international large and value, and then international small cap stocks and how that compares to the US market. So a lot of these indices that are tracking international markets, again, being very large cap heavy, they somewhat don't include or show the impact of having international small caps as part of your allocation. So it's very important to understand and identify what should my US and international exposure be, but also identify how should I be distributed across value and growth and large cap and small cap. And so the last pillar here is really going to be alternatives. So we've looked at the statistical characteristics of stocks and bonds, large, small, value, and growth. But the alternatives, as I said very early on in this conversation, it tends to feel like the Wild West because there's an incredible amount of options and factors when you consider adding alternatives to your portfolio. But the main thing of what you're trying to do when you include alternatives in your allocation is to have assets and a portfolio with components that are not highly correlated or non-correlated, meaning they don't move up and down together. They behave differently to different environments, and one's return is not reliant on the other. So here I've got, stocks and bonds and their correlation to two of the alternatives that we think are most common: managed futures and REITs. And so what this cross chart is looking at, it's a matrix, and you're looking at the correlation between all of these to one another. And so if the number is a positive one, it would mean that the asset classes are perfectly correlated to one another, meaning they move up and down almost in a uniform fashion. If it's less than one, and if it's negative, it starts to mean that they're non-correlated. If their correlation goes down, and if it's a negative number, it means they're non-correlated, meaning they move almost in opposite to one another. So what you want when you add something to a portfolio, you don't want the correlation to be high. You want to have a low or negative correlation, and so that the behavior of your portfolio is not all moving in unison, and that you've got components that are going to react differently to different events. And maybe the correlation and the statistical jargon might be getting too ahead of the curve for you. One of the things I like to do is just show investors this chart, which is all of the crisis periods. And we define crisis periods as really big dips in the stock market, with some event happening behind it, either an economic or a political event. All of the crisis periods since 1990. And I'm showing you on the right-hand side, what did the U.S. stock market return during that period? You can see it's all negative because these are bad market environments. What did the bond market return? And what did managed futures return? So this is the data that we had available. There are other alternatives that you can stack here in this column and compare. But for us, managed futures, the returns of managed futures during these periods really help identify the non-correlating aspect of alternatives. So what you notice is that, yes, the stock market was down during each of these periods. You turn on the news, you hear headlines like, bloodbath in the market. We've got a war in Iraq. We've got a Greek crisis. We've got the Fed raising rates. Whatever the reason is, it's going to be different even in the future. But what it helps you understand is that investors that were diversified and balanced, they had a different experience. They weren't, as an example, from April to September 2002, during the tech bubble, they weren't necessarily down 30% or almost 30%. If they had other asset classes and they were understanding of what their goals and their risk needs were, they could have had other parts of the portfolio up 8.5% or 19%. So again, going back to not only why and how, but the diversification approach is understanding what's my ability to take risk, what's my willingness to take risk, and does it make sense to start to combine some of these things together? So just to wrap things up as a conclusion, we're big believers in the benefits of being a stock investor long term, but we also want to be mindful of the fact that to capture the full rewards of the market, you're going to want to be a very long-term stock investor, and you're going to want to have a high appetite for market volatility. So for some people, it's absolutely 100% appropriate to have your whole portfolio in the stock market. But for others, and when I say others, I mean those that might not have as high of a risk appetite, or they feel like their circumstances have changed, or they feel like they don't need the returns of the market anymore. They need a more balanced and prudent approach for whatever that reason is. It's going to make sense to at least consider diversifying your portfolio. And we talked a little bit about stocks, we talked about bonds, we talked a little bit about alternatives. But the key thing here is to understand it's not a one-size-fits-all approach. It's not black or white. It's unique to you. And this is something that we can help you with. We can have a conversation around risk. We can have a conversation around your situation, and determine what percentage should you have in all of these different buckets. So we appreciate your attention and your time today. We hope this was at least educational and somewhat valuable. But if you have any follow-up questions or would like a copy of the slides, please reach out directly to our team member, Brenna, and I've got her name and her email on here. Thanks again, and we appreciate you joining us today.